is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott, here with Andrew Young. Andrew, you'll see I'm looking pretty sharp today. That's because I was able to buy all the crypto off of the panicking people very cheaply. And now the bankers own the crypto. So I'm feeling flush. I've got my special red tie on. I'm ready to talk the market with you. So you said just before the call that you're actually more bullish on crypto than you have been in a very long time. The Greed and Fear Index has crypto sentiment in an all-time bearish mode. So you are very contrarian. Is this hopium you're smoking, or do you have a real case for why now is a good time to look at the crypto market? Let's talk about it.
Yeah, no, I've been relatively bearish the last kind of 2-3 months, just because the stuff that was kind of leading in the crypto market was just complete vaporware. Meme coins, things like that. To be honest with you, it was mostly meme coins. Both you and I have been very bearish meme coins, and so and then sort of by proxy, Solana has also done very well. It felt like a very unsustainable sort of bull market. And now that we're starting to get some sort of somewhat short-term bearish macro, plus just obviously very bearish environment right now for crypto, the meme coins have just been nuked. Like most of them are down 80-90%. And it's also
who could have predicted it?
Yeah, but more importantly than the fact that the meme coins are all down 80-90% is that sentiment has pretty dramatically shifted. So for someone like me who's hyper online in the crypto circles, over the last 2-3 weeks, even before meme coins really started to go down pretty dramatically, everyone's kind of come to the same realization that it's all kind of vapor. And so there's been sort of like a changing of the tide where people are now swinging from just kind of pure speculation to more, hey, what are projects with good fundamentals? What are things that actually have product market fit? And I think it's very, very, like, this whole correction is very healthy. It's made me very, very bullish, actually. I think who knows over the short term what's going to happen, but I think it's sort of setting up to sort of extend this bull market and maybe make this like a little bit more of like a healthy, actual good projects rise to the top versus just complete nonsense.
Well, look, we've been, as you said, we've been bearish on the meme coins for a very long time. A lot of people have kind of gone out on a limb talking about meme coins and using some pretty highfalutin language about how meme coins are like the purest form of token distribution, how they help to build community, how they become really sticky because they've got really passionate groups of people. I mean, we now know, we knew all along, but that was always just nonsense. I was about to use a 4-letter word, but basically most meme coins in the long run lose most of their value. And the numbers were quite frankly quite staggering. I can't remember, we'll have to put it in the show notes, but something like 60,000 tokens a day were getting created on Pump.Fun and these other platforms. It's obviously those kinds of assets have no value, are unlikely to gather much interest in the long run. And this whole process of token launch, rug pull, recycle, do it all over again, became almost like the narrative in crypto. And it's wow, that's pretty depressing. Financial nihilism, they call it. So I'm relieved and hopeful, as you are, that I'm relieved that there's been this huge washout. The sort of poster child for the meme coin mania, I think, was probably this thing Fartcoin, which is down 90%. And I think a lot of others will likely follow suit if they haven't already. So now, as you say, we turn towards fundamentals. But what are fundamentals, Andrew? I'm pleased to report that we're getting tons of new listeners for the show, which is great. And so people who maybe haven't heard from us before might be wondering, okay, I'm new to crypto. What else is out there? What is a project with good fundamentals, and how might it differ from an asset that is just a thing people are excited about? Can you talk through that for a little bit?
Yeah, for sure. So the hard part about crypto fundamentals is there's a lot of projects that have very solid earnings, revenue. Sorry, I'll start with the first part. There's a lot of projects that have a great product, great revenue, but they are spending a huge amount on token incentives. And so their actual sort of protocol profit is deeply negative. So that's kind of like one aspect of fundamental investing in crypto. Another thing too is a lot of projects generate profit, but maybe don't redirect it to sort of token holders. So that's like another aspect you need to sort of pay attention to. But yeah, just generally speaking, blockchains and more specifically like crypto applications built on blockchains, they're able to generate, like some of them are able to generate pretty substantial revenue and profits. And then there is a couple that actually redirect that revenue straight to token holders through either buybacks or staking yield, which you can sort of think of as like a dividend yield. So the big one is the one that everyone talks about is this project called Hyperliquid, which is essentially the leading decentralized perpetual exchange. So perp exchanges allow you to buy crypto with leverage, up to 100x leverage. So if being long Bitcoin is not enough, you can, with platforms like Hyperliquid, you can go 100x long Bitcoin. The downside is that if Bitcoin drops 1%, you get totally wiped out. The upside is that if it goes up 1%, you've just doubled your money. It's one of the big use cases of crypto. Perpetual trading volume is about 5 to 10x spot trading volume. So the total notional volume of these these perp exchanges is a huge multiple of the actual spot trading. Again, just given the leverage. And so Hyperliquid is essentially a decentralized perps exchange, and it also has its own chain as well. And it's generating $1 to $2 million a day right now in revenue, just from trading fees and things like that. And it's using a substantial portion of that to buy back its token. So there's effectively like a daily $1 million buy of Hyperliquid token that's supported by the fundamentals of the project. And so if you're like a TradFi investor, you can kind of model this similar to a DCF or anything like that, and or like a PE ratio or whatnot.
So an application that people are using where it's generating fee revenue, part of that fee revenue is going towards buying back and basically retiring some of the tokens that are outstanding.
Exactly.
Back in a company, right?
So and so there's three main advantages of crypto asset fundamental investing relative to TradFi fundamental investing. So the first is there's incredible transparency. You can actually see the hourly revenue of Hyperliquid in real time, for example. There's essentially a real-time revenue and earnings dashboard, which again, highly, highly unique. So that's like, to me, there's so much transparency that that essentially should lower the cost of capital for truly on-chain businesses, just because you as an investor have far more information, real-time information, than a normal sort of TradFi investor, like a traditional equity investor has, for example, where you have to wait, 5 months to get sort of, you have to wait a couple months after the quarter ends to even get the results of the quarter. So that's number one, is just incredible transparency. Number two is a lot of these on-chain businesses have very low cost structures. So what I mean by that is, like, you can have multi-billion-dollar businesses with less than 50 employees. Like it's very common in crypto to have like some of the biggest projects in crypto have incredibly small teams relative to their size, because when you fully decentralize a project, there's just not that much, there's not that much OpEx needed effectively to keep the platform going, and even less sort of like salaries and that type of overhead. So,
well, not only that, so like indulge me for a second on this, which is that some of the functions that might be done by like employees are done by users, right? I mean, like, or at least on these kinds of platforms, like part of the benefit of using Web3 native applications is that you can earn ownership, like you can earn ownership in the platform through the token over time, right? So like if you're, I mean, I actually don't know this. Like on this one in particular, but like I'm guessing that, the more you trade, the more you might earn the native token, or is that something that you have to just buy in the market? Because usually the whole idea of like bootstrapping these networks and applications is to like incentivize users through ownership, right? And so they become, more active, and so that allows you to reduce the number of people you need for, say, customer acquisition, for example, right? Like that's always been part of the narrative around how Web3 applications can scale quickly using token incentives. Is that like a related point to this one?
Yeah, it's actually not how. That's more to me like a business strategy of these platforms. Like, as a investor, you actually would rather there be growth without token incentives, because I kind of think of token incentives as like almost stock-based comp, really.
Yeah, that's how I'm thinking about it too. It's stock-based comp, not to employees, but paid to users, right?
So it's a bit
with fewer people.
Yeah, which is a bit better in some respects, because if you can turn your customers into shareholders, there's a little bit more alignment, which may get you more sort of word of mouth, may also get you better retention. So there is some benefits, I would say, for this type of like expenses versus like a traditional, traditional cash-based expenses. But again, to me, the three reasons why crypto fundamental asset investing is really exciting is the three things. One is transparency. Two is the incredibly low cost structure of these platforms, and then third base is that there's very little. There's a traditional like agency conflict, where with a traditional business you hire a management team, and essentially, you have to hope that the CEO is not going to, essentially operate the business in a way to effectively enrich themselves over the shareholders. And so what's interesting with the decentralized platform is, in its sort of like end state of being fully decentralized, the core team is not even that critical to the functioning of the platform. So you kind of remove this, like, to me, I think of it as kind of like, agency risk or counterparty risk with the management team, because it's effectively like a self autonomous network. And so to me, those are like three reasons why crypto assets are pretty interesting. I think there's a lot of pitfalls with crypto asset investing. There's a lot of what are called value traps. So what I mean by that is it's pretty common for projects to look very, very cheap on a PE or like relative earnings basis, but if you look at their market share, it's just kind of collapsing. So like a good example of that is like a project like DYDX, which was paying like a 10-15% staking yield paid out in USDC from earnings. But, its market share of the perpetual exchange market has fallen from like 80% to, I think, less than 10 now. So like there's a lot of stuff you have to balance with this type of stuff. But I do think I think there's going to be like a new breed at some point of kind of like fundamental based, liquid crypto investing. That's pretty unique. And it's kind of only possible now because there's so many businesses that are actually throwing off cash flow. Like 5-6 years ago, this wasn't possible because there's no projects really throwing off earnings. We're kind of hitting the maturity stage where there's now like, 50 projects at least that are throwing off substantial earnings. Still relatively small, but growing.
So 2 follow-up questions. Number one, how, the principal agent problem, right, that you just described between like will management act in the best interest of economic stakeholders, is something that we've seen occur in the public markets before, right? And sometimes it ends up in huge blowups like Enron or Lehman Brothers or something. But it's not like crypto's immune from that, Andrew. I mean, like there are lots of examples where founding teams have huge influence and power and use that influence and power to enrich themselves. And there's nothing wrong with enriching oneself if everyone else participates, but sometimes it seems like it comes at the expense of others. So I guess the question would be, like, what projects are you actually talking about? Like, what are these projects that are sufficiently decentralized where the founding team doesn't have much influence, so there isn't this principal agent problem, but where it's still thriving and growing? Because I do think that there's some, things that are sufficiently decentralized that maybe are not altogether interesting investments because, having a group of people that's at the helm pushing something forward can often be an asset. So what are those examples? Like, not all of them, but like, what are a couple that come to mind?
Yeah, like, well, one is, I think Ethereum,
Ethereum.
which is, yeah, Ethereum. But the funny thing is that some people don't like the fact that there's not like a core team driving progress forward. Like, a lot of people have actually said that it's kind of a downside. And actually, Vitalik today just announced the sort of executive director of the Ethereum Foundation just stepped down, and everyone was kind of sort of cheering that a little bit because they wanted someone a little bit more hard charging and sort of more in the weeds. So I'm not saying this is like a unanimous view, but yeah, I think like another project is something like Aave, where there's still a core team and they're still they're still involved, but for the most part, the project is relatively sort of autonomous at this point, to a certain extent, and it's throwing off quite a bit of revenue and earnings, and because of that, the token has like outperformed quite a bit over the last 6 to 12 months. So I think like there is definitely some. It's still very early. Like, the way I think about it is like crypto moves in stages. So the 2017 bull market was just tons of projects, but none of them really had products. Yeah. 2021, some of them had like the projects that were good had products at least. 2021 cycle was most projects had products now, and some had revenue. Not many had earnings. Now this cycle, I'm starting to see projects with earnings. Most projects have almost all projects now have products, and a lot of them generate revenue. And then there's like the sort of the elite ones actually produce earnings after token incentives and things like that. And there's a couple that are now starting to actually throw that back to token holders through sort of like buybacks, staking yield, things like that. So I think like the next stage will be the 2029 cycle will be projects generating substantial earnings, and the ones that are really good are fully decentralized as well. So they have all of these sort of huge, in my opinion, huge benefits. And sort of because of those huge benefits should trade at like a much higher multiple, or like theoretically should trade at a higher multiple than like a traditional sort of equity-based business, just given the like lower risk to investors. Again, this is kind of like, this is where we're moving. It's still, I'm kind of talking about the future, I would say, but there is some projects right now that are building towards that vision, both in terms of like, a profitability focused vision, having the value returned to token holders, and of course also fully decentralizing. So I think those are the projects that are most interesting to me as like a crypto fundamentalist.
Yeah. Do you know if there's a screener somewhere on the internet that screens for these kinds of things? Like, I think this is something.
I'll give a shout out. I'll give a shout out to a project called Token Terminal. They're very, very solid. Yeah, very, very solid. Kind of like a Bloomberg terminal for crypto. Messari is also pretty good. They are less. They don't have as much data, and like they're not as focused on like profitability as something like Token Terminal. But they have like a full research coverage. Doing a good job there as well. So yeah, these platforms are definitely growing. I think there's still a lot of like crypto alpha in actually using these platforms, just given that the average crypto investor right now is not using these platforms. Is to be honest with you, like it's just trading. So I think there is actually like a pretty big there's a pretty big like hole in the crypto asset sort of investing space to take like a long term like I'm gonna invest in like compounders, projects that are going to compound year after year, and then like return that capital to token holders over time. Kind of like a more of like a Berkshire Hathaway sort of model of investing. Now just to like counter everything I said, there is a big.
I don't even have to say anything on this show. This is great. So now, what's the counterpoint to your point?
Yeah, sorry. I really love this sort of. I love this subject, so I'm pretty interested in it. But the counter, of course, though, is that you want to invest in projects that are going to be the long-term winners. So like, there's kind of like two ways to think about this. There's one way. I think about investing in crypto as like sort of a hybrid equity model where, figure out the earnings over time, and projects that are delivering sort of profitability and returning that to token holders is great. There's another sort of school of thought, which I would say is more like the VC sort of line of thinking. And I think is also another like smart way of thinking about it is crypto is likely going to be a winner take most. Like most of the verticals in crypto are going to be winner take most. And so short-term results don't matter that much. It's really about picking the long-term winners within specific categories because the markets are so big and we're still so early in the adoption curve. And so that's kind of like more of like what I would say like a call option based valuation model. It's like, okay, this market's $100 billion. I think this project has a 10% chance of being the winner. And therefore it should be, therefore the valuation should be a couple $1 billion or something like, $10 billion with a discount. So that's like another way of sort of thinking about it is like picturing the end state of the market size. And then kind of like assigning a probability to the winner. And that's kind of like how a lot of VCs in the space sort of think about it. They think about projects as like effectively a call option on like a specific sort of future. And I think that also kind of makes sense too.
That famous scene from The Social Network where Mark Zuckerberg sits down with Sean Parker from Napster, and Mark Zuckerberg's partner Eduardo Sabrin is out like trying to get advertisers for Facebook and trying to like monetize the platform, and Sean Parker's like, it's cool, not $1 million, $1 billion, and it's like, what is the metric that matters the most today when dealing with like an early stage, like what is effectively an early stage and emerging industry, looking at projects that are still pretty small in the context of like the broader market, right? Is it that they have a strong, EBITDA margin, or that they're already buying back their stock or whatever, or is it that they're growing like crazy and they're kind of grabbing as much market share and they're going to become like the dominant player in each of those verticals? I actually have no effing idea what the answer is to that question. And it sounds like there's kind of good explanations on both sides, right?
Yeah.
It's like, why are we so focused on profitability now when we should be thinking about hyperscaling as fast as humanly possible?
Yeah, no, it's a very, very good point. A good project that is kind of like in that camp is a project like Celestia, for example, which is we should get actually some of the team members on the podcast. And they essentially they built a chain that provides data availability to rollups. So if you're like a L2 or L3,
data availability.
Yeah. So essentially, if you're building your own, rollup or L2, you need somewhere to essentially store the data of all your chain, right? So that, and then you need to make sure that it's available 24/7, and effectively like also decentralized, so that it can't just be like modified or essentially so that people can't just like rewrite the chain and steal all the money is effectively an easy way to think about it. And so right now, like Ethereum, well, up until a couple months ago, Ethereum sort of dominated this space, but it's very, very expensive for rollups to sort of store their data on Ethereum, even after sort of the blob upgrade, which also lowered it. So anyways, moral of the story though is Celestia allows people to store the data of their rollup on a much cheaper sort of much cheaper chain, which allows like much faster sort of transaction validation and much cheaper sort of transaction fees. And so, however, part of this like low cost model is that Celestia generates very, very little revenue for how much sort of data is being stored. I actually think they're sort of subsidizing a lot of this right now to just kind of go for pure growth. And so a lot of people kind of look at Celestia and they're like, it's like a $5-6 billion market cap and it's doing $100 a day in revenue. Like that's kind of insane. Right. And so from like a traditional sort of perspective, it doesn't really make sense. But if you think about it as like, okay, data availability is going to be, we think it's going to be $100 billion, $200 billion market cap, or sort of market size, because there's going to be 10,000 chains, and it's probably going to be a winner take most market. And we think Celestia has like a 20-30% chance of winning it. So in that perspective, then you can kind of like, you can get to like a $10 billion sort of market cap valuation that actually makes sense, or maybe it's even cheap, because like they're optimizing for hyper growth, right? They're trying to win this market. The downside, of course, is that you're taking if the market isn't as big as you think it is, and or the ability to actually accrue value is much lower, then even if the platform grows a ton, the fundamentals just can't support like that level of valuation. And so you could be right and be wrong at the same time. Whereas the counter is, obviously you invest in a project that's generating lots of earnings, but it just kind of stagnates and doesn't grow. And even if it's throwing off it gets even more and more profitable, you missed out on this huge, the industry grew 100x and you invested in something that only grew 2x. So that's kind of like the value trap. So yeah, I mean, it's very, it's hard to know, right?
Well, I think about something like Celestia, and it's like, okay, what is Celestia more like in your mind? Is it like a discounter that sells something cheaper than anybody else will sell it and will make it up on volume by becoming the data availability layer for like all these layer 2 rollups, or is it more like a 2010s VC subsidized startup that is like only able to grow through inflation and through like all the money that it's raised at this early stage, but eventually that's going to catch up with it and it's going to have to change its business model entirely? Like what is it more similar to, in your opinion? Because like if they're making $100 a day, they're not making payroll if there is a payroll, right? Like they're not able to actually pay for what they're doing on that alone.
I think it's more the latter. I think it's more, and like that's like the strategy of Celestia and all these projects, right? Like we're going to maximize for market share and growth, and we'll figure out the economics.
Subsidizing growth through invested capital, like growth capital,
yes,
provided by third parties,
100%,
in order to hit critical mass, so that we have this moat, and then nobody will be able to compete with us, right?
Yeah, and that is like the bear case on Celestia, is that they've had to raise a ton of money, so there's constantly sort of unlocks, like VC unlocks, quote unquote, because they've sold a ton of tokens to VCs to raise the capital necessary to sort of pursue this like aggressive but subsidized growth strategy. Right. As like a founder of like an L2 project, it does make us more likely to go with something like Celestia, just because they're offering us a much better deal in the short term, and there is like some switching costs with all these things, right? So which is something that like as an application and sort of roll up founder you have to be wary of, is that like at some point they will have to accrue value, and so it's kind of like you're getting a short-term win, but maybe you're locking yourself into a project that long-term will sort of use its size to sort of raise prices. So I mean, it's tough. I mean, it's sort of a tough call as like a L2 like application founder, but in the short term, it does make the economics of using someone like them much better. It's kind of like what Solana is doing in a lot of respects, right? Like Solana is still inflationary, right? Like it still pays out more in sort of staking rewards to validators than it does generate in actual real revenue. And so effectively it's subsidizing the network, right? Like it's not generating, it's not profitable if you think about it from that perspective. It's paying more for the security of the chain than it's earning in revenue. And that's been incredibly successful, right? Like they've onboarded tons of applications and now it's quite big, right? So now they could raise, transaction fees could increase a bit and it wouldn't slow down much activity because there's just such a liquidity moat. So I think I guess what I'm trying to say is I think projects kind of naturally go through the cycle, right? It's kind of like how Uber right now has been one of the best performing stocks in the last 12 months, right? Because the new CEO is just laser focused on profitability, and everyone already has Uber downloaded and it's already like part of, your daily routine, that them increasing prices, you'll complain about it a bit, but you're still going to use Uber. And they're just so big that it's pretty tough to create a new sort of Uber nowadays. So there is like barriers to entry. And obviously required a huge capital expenditure over a decade to get to that point. But it obviously, if you look at the stock, it's been definitely it's been doing well. So to me, like Uber is a good example, right? Like you optimize for market share, you try to win the market, and then you start to optimize for profitability.
Yeah. Well, I think that they're trying to pull from that same playbook. So going back to the market then, because we started with what's going on in the market, and got into what actually are the long-term drivers of kind of crypto growth and value growth. There was an interesting bit of news this week, which is that the SEC has dropped its case against Coinbase and also against Robinhood, and actually just recently against Uniswap. And I think that the Uniswap one is the most interesting. I haven't had a chance to read their blog post about it, but basically there was a point of view like last fall after the election that there's all these DeFi applications that are widely used, or at least have lots of users that have generated excess earnings, and that they would love to return some of that back to token holders and users, but they haven't been able to do that because of uncertainty around whether or not that would be considered like to basically turn their token into a security and turn that into like a dividend or coupon payment or something like that, right? So effectively, like, would doing some kind of on-chain reward for people who have helped you build your business, would that be construed as something that should have happened in the regulated market? And I think that this is one of the reasons why right after the election last year, some of the like old school DeFi blue chips kind of popped, but then that didn't really last, right? Like that rally came and went. And I'm wondering, given the circumstances, you've got meme coin mania has finally ended, and you have this emerging narrative now about fundamentals. And now you've got this like group of projects that exists and is in a world where maybe they'll be able to return more value to token holders. Whether or not that makes a strong case for the applications that are doing that have been creating a lot of value and could potentially return it to token holders. I feel like so far we've mostly been not directly, but alluding to like infrastructure, like layer ones, and the I don't know, is Celestia layer one, or is it just like a component of
it's layer one, yeah.
I guess it's layer one, right? But it's like infrastructure versus apps, right? And I'm wondering if we're going to start to see a bit of a shift. But I also agree with you too that like every cycle needs new kinds of applications. Like is Aave and Compound and Uniswap going to be like the big names for this cycle? I don't think so. I think they could do really well, given like the conditions I've described. But I kind of think we need another crop of winners to emerge before we get back to all-time highs, right?
For sure. So I think like Aave and Uniswap, they went through the like that Gartner hype curve, right, where it's like a crazy curve, and then it comes way down, and then it just starts compounding forever. So I think they've kind of gone through that whole, the curve, and now they're just like on the sort of the long tail end of just compounding steadily. And that's why you see more of a focus on profitability from both Aave. Uniswap's not really there yet, but it's at least moving in that direction a little bit. One of the things I don't love about Uniswap is that they added a front end fee where Uniswap Labs has made about $150 million in revenue off the app. And none of that value has actually gone to the token holders. So I think that's like pretty, I don't think that's like great alignment, to be honest with you. And they're sort of trying to address that with Unichain. The idea is like they built their own rollup, and then the sequence of revenue from the rollup will go to the token holders. But the thing is Unichain was a bit of a flop, at least 2 weeks in, still very early, obviously. And like it's not really going to generate substantial revenue, or at least doesn't seem like it's going to generate nearly as much revenue as the front end fees. So there's that aspect as well, I guess, just in terms of like value accrual and alignment. Whereas I would say like Aave is a bit more fully aligned in terms of like you buy the Aave token and you get access to the economics. I think so. To answer your question on like who are going to be the big winners, again, I would say we're kind of like mid-cycle right now. It seems like on one hand, Hyperliquid is a huge winner for the perp space, and then on the sort of like spot token space, it looks like Pump.Fun is going to be the huge winner. I mean, it obviously is the huge winner. I think it made like $500 million in Q1, some absurd amount of money. And they actually just announced that they are going to launch their own DEX. So right now, when you launch a meme coin on Pump.Fun, once it gets to a certain market cap, it moves to Radium, which is like one of the leading DEXs on Solana. And then all the trading and trading fees goes to Radium. And so what's interesting is that Radium for the last like 3-4 months has looked very, very cheap on like a PE basis. But the market was actually quite smart because it effectively had, to a certain extent, priced in this possibility that Pump.Fun would, instead of sending them all the token and all the trading flows to them, they would create their own DEX and effectively cut them out. And that is actually what happened last week. And the Radium token was down like 50%, I believe, in like a couple of days. And so like you do have to think more strategically. It's not like you can't just look at PE ratios in crypto and be like, it's a very fast moving industry. And most of these are like 2-3-year-old startups. So you definitely don't want to use like a PE ratio to like, you can't just run a factor model where it's like low P ratio, buy that, short the high P ratio, because there's a lot of like discretionary logic you have to use. But again, I think that's why this space is so interesting for a fundamental investor, is that it's not, there's a lot of like inefficiency in the market is what I would say. And if you kind of do your work, I think there's a lot of like alpha to be had. And like, again, like the space is so short-term greedy that if you take kind of like a long-term greedy approach and try to find projects that you really like and sort of invest in for the long haul, and they can just keep compounding, then I think that's a really good strategy. So we'll see. But I think we're kind of at the point now where, like I said, the pendulum has switched to fundamentals, I would say. So it should be, I'm kind of excited for the next like 6 to 12 months. I think it should be good.
This conversation is reminding me actually of a research report that I co-authored with friend of the pod, Arian Shekhalian, who's the head of research at CMT Digital. And it was all basically about applying like a Benjamin Graham like value investing approach to crypto. And that was, I think, a year ago. I'd love to go back and revisit that to see if anything that we said then still holds up today. My guess is that it does. But even then, like you said, it rewards people who like to do the fundamental analysis. But it actually sounds like we don't even know what the fundamental analysis is. Like, what is the right way to value and measure these types of projects, right? And I feel like that's been this topic of debate, I guess. Debate is the word, for a very long time, right? Which is like, is Solana worth more than Ethereum because fees are cheap, or was Ethereum worth more because it was earning a lot of money, or was it worth less because or because fees are high, it actually is not as appealing? It's always there's a lot of different ways of kind of like skinning a cat and looking at this thing. So very interesting, Andrew. I want to add a new segment to the show here. We haven't done this before, but behind the scenes for many months, and actually I think we're now into like a year and a half, has been Jake Moody, who's the associate here at the 9 Point Digital Asset Group, who puts together and produces these podcasts every single week. Writes about 2/3 of our weekly note. People think it's mostly me, but of course, Jake's behind the scenes doing a lot of the work. So Jake, you had some interesting data you wanted to share, going back to the market, about where sentiment is at today compared to previous cycles. So talk to us.
Yeah, so just to put that into perspective, right now the crypto market fear and greed index, it's at 26, where a week ago it was at 50. And right after kind of Trump won,
out of 100?
Out of 100, yes. It's from 0 to 100. When it's like right now, it's at 26. So it's at an extreme fear level. And yeah, about a week ago, it was at 50. So it's kind of like neutral zone. Right after Trump won, it did go to 86. So it was like very, very greedy sentiment. But the last two times that the sentiment was this low, the most recent was this past summer. And it was kind of a trifecta of things. It started with the German government. They had some Bitcoin that they had seized. And so they were starting to liquidate that, which kind of feared the market a little bit. And then adding to that, there was kind of news that Mt. Gox would begin distributing Bitcoin to creditors, and there were liquidation fears there. And then to top it off, it was kind of the yen carry unwind was happening. And so sentiment kind of fell off a cliff because there's a big sell-off in the crypto market. But then before that, the other most recent time was the end of 2022, right after the FTX collapse.
Oh, wow. Okay.
So I think that's pretty wild because, Bitcoin is at about 86,000 right now. And, the regulatory climate, it feels like it's stronger than it's ever been before. Institutional adoption, stronger than it's ever been before. Corporations are buying more Bitcoin than they've ever bought before. You have all of these lawsuits being kind of dismissed by the SEC against all of these different crypto firms. So it feels like there's a very strong foundation for where we are now, and the fact that it's that low, it usually means it's a pretty good buying opportunity. But we'll have to kind of see where that goes.
Yeah, pretty interesting. I mean, I get that sense too. Just like on Twitter and talking to people are so bearish on the market, and it's like, and even CZ posted online. He's like, I can't wait to see a future headline where it says Bitcoin crashes from $100,000 to $85,000. That was like 5 years ago. He posted that and he retweeted that. And he's like, I can't wait to see it when it goes from like 1 million to 850,000. So like, I think people definitely lose sight of the forest when they're like in the weeds, so to speak. And I don't know, like the last summer was definitely almost part of this whole trend of people being bearish despite fundamentals improving. The time before that, FTX, I mean, that was like an existential risk to the entire industry. So, Benjamin Graham, in the short term, the market is a voting machine, and in the long run, it's a weighing machine, right? So right now, people are voting with their feet. People are scared. They're bearish. But in the long run, if we're right, this thing's going to weigh a lot. And I think it's going to be driven a lot by some of the stuff that Andrew's talking about, which is like, where's the fundamental value accruing across these different platforms? Very interesting. Thanks, Jake. All right. Well, I don't know. Oh, yeah, go ahead.
I have one more point that I'd like to share that kind of, I think, summarizes what you guys were talking about this episode.
Yeah.
It was a tweet that Matt Hogan, the chief investment officer from Bitwise, he put out a couple of days ago. And it was a prediction. He said, in the next 12 months, the total crypto market cap, it's going to double, but the median crypto asset will be down by over 90%. So essentially what that means is there's basically 1 million of these meme coin tokens that are being created every single day. And well, that kind of caught the attention the past little while. All of those are basically going to go to zero as, people kind of flock to more fundamental projects, which you guys were talking about. So I think that was a pretty interesting tweet and one that I think kind of summarizes this episode.
I like it. I mean, if this is the new era of the web, the new era of the internet, it's easy to launch a token as it is to launch a website. Most of the websites from the 90s aren't around anymore. Most of the tokens that are created today aren't going to be around in 20 years either, or 20 days, at this rate. But emerging from that group is going to be, the next very disruptive business that ends up changing the world, I think. So that's it for this week's episode. Thanks, Jake, for chiming in. Really appreciate that. Andrew, thanks for your insights. Pretty light lift for me today because I had some smart people doing all the talking. But we will be back next week with a great guest. Stay calm and carry on, and we will see you next time. Take it easy. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.